15 years of stocks versus bonds and in between. This is directly from Morningstar that my man Chuck had sent me an article, and I want to, a couple of you have, a number of you actually have asked me to do this on the whiteboard, as the whiteboard is easier for some to understand than an Excel spreadsheet, or never mind my my vomiting from my mouth. So what we're doing is we're taking the stocks, which is I think it's S&P 500, I'm sure it is, and the bonds, which is the aggregate bond index. We're using those as our front, our bottom and top, and then we're combining 50-50, 60-40, 70-30, 80-20, 90-10 stocks versus bonds. The premise of this, the article, is why you need more stocks in retirement, which I completely concur with, by the way. We're looking at the last 15 years, so that's going back, 2005 until 2019, all right? And we're going to look at standard deviations. That's SD is standard deviation. We're going to look at the top and the bottom with a standard deviation of this right here. So this is what the top and the bottom would be with 3 standard deviations. We'll talk about that here in just a second. And then we're going to show you what the rate of return would have been on average if you got the average rate of return over those 15 years. Let me just see if I can't move this guy. Hit that. There we go. And we got my Sleeping Beauty down there. Hello, Sleeping Beauty. All right, so let's go into this. I think it'll be interesting. All right, so here's the aggregate bond index. The return going back for the last 15 years was 4.39 on average. Standard deviation was 3.28. All right, now, yeah, I can't really do that here. But that means 99.7% of the, 99.8% of the time, I think, you would have got 3 standard deviations, either negative 3.5 or positive 14.3. So it's basically, how can I say this? 99.8% of the time in any given year, you would have got a negative 5.5 or a positive 14.23. I hope that makes sense. 68% of the time, you would have got, I don't know what that would be, 4.39 plus 3.28. Let's just say that's roughly, 7.5% on the positive or negative 1% on the down, if that makes sense. So that's how standard deviation works. You basically take your average rate of return and you subtract by 1 standard deviation to get the negative, or you subtract by 2 standard deviations to get 95% of the time rate of return, or you subtract by 3 standard deviations to get 99.8% of the time. I hope that makes sense. And what to get subtract, you just literally take this, you times it by itself for 1, times it by 2 for 2 standard deviations, and times it by 3 for 3 standard deviations. I don't know what 4 standard deviations is. I don't know. If 99.8 is 3, I imagine 4 is probably 99.9 or something like that. I just don't know. But anyway, so that is your standard deviation, is you're saying 99.8% of the time on any given year, you got a negative 5.5 or 14.3, something within those constructs for the last 15 years. Now, again, this is hindsight looking. This just says what it did in the past. It doesn't say anything what it's going to do in the future, especially when it comes to bonds. But in the past, this is what we got. What can you extrapolate from that? Well, I think it's a good starting point. But when it comes to bonds, I'm not so sure, given that the rates are so low. But be that as it may, it's still a good point to look at. I don't have any qualm with that at all. People always say, well, standard deviation, hindsight, I get, what else are you going to do? We don't know. Anyway, so in this case, if you put $100,000 in this portfolio of bonds and you average 4.39% a year, you would have $190,000 after 15 years. With a worst case scenario, would have been down 5.5%. That would have been the worst case scenario with that standard deviation. All right. So now we go to 50-50 stocks to bonds, and we got basically 50% more in return, with about 150% more standard deviation, about 300% more risk on the downside, and maybe 3.5%. So you can see the higher the standard deviation, the more downside risk there is. So 99.8% of the time, if you had a 50-50 portfolio, you were down 18%, if that makes sense, 99.8. So what I would do is I say, okay, after 15 years, you would have averaged 6.97, so your portfolio would be worth $274,000. So what I would do here, if you were sitting with me in my office on Zoom, and the Chinese were infiltrating, because they do, the Zoom is certainly part and parcel with the Chinese commies. If you were sitting there with me, I would say, look, There is a 99.8% chance you could be down 18% if last 15 years are any kind of evidence that we can extrapolate going forward. Now, I think it's good. I think it's a good place to look at. Again, because we just don't know. So this is just as valid, if not more valid than anything else. I say, so 274,000 minus 18%, that means they're 99.8% of the time in any given year, you could be down 50,000 from that number. Does that make sense? That's how I do it. I say, look, I'm not saying that you will be down 50,000, but I think that's what we have to wake up and say, so Mrs. Smith, you're sitting here with me on Zoom right now, and Deng Xiaoping is looking at us, what's the guy's name? The Prime Minister, I forgot. Anyway, he's watching us to see how you are invested. Anyway, so I'm sitting there saying, so you have 274,000. If we fast forward a year from today, you could be down to 224,000. Are you okay with that? All right. And you say, that's $50,000. Are you okay with that? You say, I don't know. I say, okay, that's the problem. Now, on the other hand, we got 274, right? 274 times 1.32, you could be up to 361. So you could you'd be down roughly 50,000 on the downside and up 90,000 roughly on the up. All right, so is it worth a $50,000 decline potentially to get a $90,000 increase potentially? I don't know. It's a tough one. Now, the problem is it doesn't just stop there. Now you got to say, well, all right, so if we do go down, and this is the issue with Monte Carlos and stuff. I'm telling you, it's a tough one. If we're down $50,000 a year from now, has this changed that much? Is standard deviation? Could we be down? Is there a 99.8% chance that we could be down another 18%? Yeah, or something thereof. So you could say, now I'm at 224. I hope this makes sense. I think a lot of people just look at it 1 year. You got to look at 2, 3. So you say, okay, so now I'm sitting on 50-50 portfolio that was down 18% for year 1, but now I'm at 224. I'm not out of the woods. There's still an 18% chance, 99.8% of the time, I could be down another 18%. So now you're down another 18%. Now you're down to 183. So you're down another $40,000. Is that acceptable? So within 2 years' time, this 274 could be worth $90,000 less. Are you okay with that? And that's without any pulling money out. That's a challenge, man. I'm telling you. Now, on the other hand, that could be worth a whole lot more than 361. It could be worth another, 450 or so. So are you okay with it? Does that make sense? That's how you got to weigh this stuff, not just 1 year. Yeah, I can take a $50,000 decline. All right, so now we fast forward to that year. You're down to 224, and now we have to do the same thing. Can you take another $40,000 decline? That's where it gets challenging. And I'm telling you, man, this is where people start freaking out when it comes to the market. They start saying, I just stop the bleeding. I don't care if I'm lost. I just got to stop the bleeding. And I tell you, this is why you really need to have cash on the side so you can arrest that need to stop the bleeding. Because the minute you stop the bleeding, that's called capitulation. That's usually the sign when the market will kick back in gear. I've seen this so many times. All right, so I hope this makes sense. So let's keep going down. So now we'll look at an 80-20 portfolio. We'll just skip around here. 8.12 is the average rate of return with a standard deviation of 13.47. So basically, an 80-20 had a little bit more rate of return. What's that? About 15% higher rate of return, with essentially a doubling almost of the downside risk. So here was a 50-50, was down 18%. Here you're down 32%, a doubling of the downside risk. Now, of course, with the doubling of the downside risk comes with extensive potential for increases too, 37.5 or 32 to 48.5. So that's a 50% increase in potential return on the upside. 32, 48, that's 16% difference. 16 divided into 32 is 50%. So now here, our 274 after 15 years is now worth 322. So essentially, here's what I say. So that made you an extra, we'll say $50,000. You made $50,000 more than you did a 50-50 portfolio. But now you're at 322, and now you have a potential 99.8% of the time, you could be down 32% any given 1 year, minus 32%. So now I'm saying you're down to 218. All right, so you're down $100,000, $105,000 here, 218. Now the interesting thing, what was this? We were down 225. So we're only off this guy to that guy by $7,000. I hope that makes sense. So basically we're sitting there thinking, so all the risk, even though there is significant risk, the difference between 1 year difference between these two is $7,000 on the downside. Does that make sense to even have that? If I can, I don't think so. That's my issue here. So in 1 year, yes, I'm down 32%, but I started because I started such a higher amount. I'm only down at 218. In 1 year, I'm only down 18%, which is basically 50% less. But because I started at a lower amount, I'm down to 225. I hope that makes sense. So now we say, okay, 274 minus, we know this was down to 183 after 2 years, two consecutive worst case scenario years. This is down 3322 minus 64% is down to, 322 minus 32% minus 32% is down to 148. So that's where it is. So now we're at 183, now we're at 148. So that's the second years where the blow comes. I say, can you handle those 2 years? Now, the likelihood of you getting two consecutive negative 32% years is not high, but it does fall in the bell curve of standard deviations. It could happen. It could. But anyway, either way, this is at 183. This is, what did I say, 150 roughly. So you're still only down 30, 150, $33,000 difference between the two. $33,000 difference between the worst case scenario happening twice consecutively versus on average you would have made $50,000 more. So essentially the way I look at it is, all right, you're sacrificing $30,000 more on the downside for a not high probability, where you have $50,000 more on the upside, which literally happened if you just would have left things alone. I hope that makes sense. That's why I say why even mess with bonds is what I'm going with this, because yes, you do limit the downside, but if you have any stocks, you still have significant downside. You do. And that's all there's to it. And then if we factor in another 30 years, the gap between stock and bond performance grows and grows and grows. And lastly, we can just look at 100% stocks. Now here we got a negative 42%, but we've averaged 8.7, which doesn't seem that much different from 8.12 or even 6.97. But we would have made 350. So again, now we're sitting in my office. You got $350,000. I'm like, okay. Now there's a standard deviation, 16.94, which means 3 standard deviations, you could be down 42%. 350 minus 42%, you'd be down to 203. So after 1 year, this is still more than that and that, even though we had a 42% decline. Now after another year, you'd be down to 117. So in the second year, 117, I think this was 150, and that was 183. So now we're down $60,000. But we, again, not likely to happen. But if it did follow the bell curve, you would be down to 117. But this is down to 183. So we're down $75,000 roughly between the two on the downside. But on the upside, which is a hell of a lot more likely to happen, we have $75,000 more on the up. Because again, this assumes 2 consecutive standard deviations or 2 consecutive 3 standard deviation declines. It's never happened like that. It could, it just never has. So I'm like, I don't know. So if we just use one, well, you have to throw the second one in there too, just so people get a gauge. Just because it happens in 1 year doesn't mean you're out of the woods. We have evidence of this. 2001 and 2. 1973, 1974, and of course the 30s. So we have 3 pretty significant evidence of long declines. But 2001 and 2 is 9, 11, and 22, and that's just the S&P 500. If you have value stocks, you didn't get hit at all until 2002. 73, 74 is down 18 and 23%, something like that, about 48% respectively. Nothing anywhere near this right here, 73, 74. And then, of course, in the 30s, we never had anywhere near this consecutively either. It just didn't happen like that. Anyway, I hope this helps. A lot going on there. It's just my preference to say to people is like, look, if you're going to minimize the risk, don't have any bonds at all. Just have cash or Ginnie Mae. I mean, literally, that will help you minimize the risk. Or just, literally CDs. and then have stocks. And then when it gets dicey, you've got to hang in there. You've got to. Hope this helps. Love to hear your thoughts. We'll see you.